Ladies and gentlemen, and welcome to this afternoon webinar. My name is Theo, and I'm here to present you your host, Jens. So you can go through the webinar subject. Just to make sure that if you haven't subscribed on our YouTube channel, please make sure. I will send you the link below. You go to Admirals and you just press the subscribe button. Also, let me just navigate you quickly through the channel. So this is the YouTube. Just bear with me. So your YouTube channel here. You scroll down, and here at the trading spotlight, you will find all the valuable webinars from Jens and from the other, from Paul and myself. And also just, we have Dr. Elter's webinar, but I think that's mostly in Russian language. If you scroll down, you can find many other information. Also, we host the live trading sessions Monday to Friday, 9:30 a.m. ESST time. So just make sure you subscribe to that one as well. And then we have the Admirals Global on Instagram. Here you get the link as well for the Instagram page. Please make sure you like the page here and you follow us. We post on a daily basis many stories. On a regular basis, we post information about stocks, about earnings, NFT, and a few other stuff. That's very informative for you. And the last one, it's the Telegram channel where we put whenever we're about to go live and many articles. So you can click the articles, they take you directly to our website. So you can just go and find all the necessary information. So Jens, welcome. Hello. It's pleasure to introduce you to this webinar today.
Hello, Theo. Nice to nice for having me. Thanks for having me.
Yeah. So I will give you control of the mouse and the share screen, and I wish you to have a great session.
I hope that people will enjoy the upcoming minutes as much as I had fun to prepare it. And the trading gods were with us. Let's put it that way. With the inflation data on Tuesday, we probably got a great fundament to build from for the upcoming Fed session next Wednesday. And so the idea behind these webinars in general is to dig a little deeper, and not just into the fundamentals in general, but also to dig a little deeper into the question, what can we make out of this from a trading perspective? And the interesting thing is, it's not just a rate decision, but it's also that we will get some very important information on what to expect in the upcoming events. And this time it's probably even more important. And I will not just dig deeper into what is a rate hike or rate cut, or why this is of importance, but probably what is more interesting here in this context is the so-called dot plot, and what this is and why this is of high importance, and how we can not just interpret or learn something out of this and understand it theoretically, but also make something out of this for the upcoming trading sessions respectively, then get something out of this from the rate decision on Wednesday. This is exactly what this webinar will be about. So in general, I don't think that I need to introduce Admirals, the broker behind these webinars who makes all this possible. Here I need to introduce Admirals any further, but we can just jump into the action and have a look here at today's agenda. And and in fact get an idea of what we will talk about today, respectively, what we can make out of this, especially trading wise. Interesting enough, there's a little mistake here. It's not the S&P 500 we will look at, but we will dig into the NASDAQ, in fact. So there should be, it should read NQ 100, not SP 500. So this is very important, but we will dig deeper into this after we got an idea. And before we start to have a look here at this, and by the way, let me just share the link here from the Fed Watch tool, where you can find this information for yourself in the future. It's of high importance. It's not just important from a rate decision perspective wise, but also what market participants are expecting. You probably have heard about that psychology plays a key role in trading. It's not just because for us that it plays a very important role to have our emotions under control and so on and so forth, but also to understand what's the current bias among market participants and why does the market react under certain, let's say, conditions differently. Or in a special way that has mostly to do with the thing, or with the expectation of the market. And now you might wonder, where do I get information around the expectation of market participants? And the Fed Watch tool is one thing to dig deeper into this. But before we have a look here, I want to dig deeper into what happened. Especially last Tuesday, even though this topic around inflation has been with us now for quite a while. You probably have seen it that on last Tuesday, inflation data was released. And if you haven't seen the data itself, you most likely will have seen the reaction. Let me just here go into the MT5. You probably will have seen this candle, or respectively, let's go to a 50-minute chart. Probably you probably have seen this one here, and you wondered afterwards, okay, where did this come from? Why did this happen? And the reason for that, I wouldn't say it's easy, but at least you could have expected some kind of volatility. Probably that's a fair way to put it. And the reason, the trigger for this was the inflation data, which was released, and it was released, interesting enough, here at 8.3%, month on month in this case, for the month of August. And we were expected to come in at 8.1%. So now, the interesting thing is that over the last 12 months, you probably have seen that inflation picked up. It has been a topic, not just in the US, but also around the globe, in fact. And then we were starting to wonder, okay, when is the peak reached? Let's put it that way. When do we have a chance to roll over, or when do we see some kind of tendency to roll over? And some market participants were already talking about this in July. And you could also see that when looking at the chart, because the thing is that over the last months, especially probably the last 12 months, inflation expectation, or respectively inflation data, which came in, picked up. And what you expect usually then is a central bank to fight inflation, to do something about it, because inflation, we will have a separate webinar on the topic inflation. But all in all, we can say that rising inflation usually is only positive to a certain point, especially if it's demand driven. Let's say, if as of now it's supply driven, we are facing a problem because we don't know when there will be enough supply in terms of, let's say, fuel or gas or whatever. And that being said, then leaves companies with the problem that there is rising costs for these companies to do business. Put it really, really simply here. And so that being said, then not just that companies see a dropping margin, but also in addition to that, people can afford less for the money they have in their pocket. And this is usually then resulting in tensions, may it be social tensions, may it be political tensions, whatever. And thus you expect, especially if you see such a rise step up here, which saw an acceleration after the invasion of the Ukraine by Russia here again, but it's not the main reason. That's very important. That's something politicians want you to believe, but it's not the main reason. Inflation picked already up earlier. That was mainly due to the fact that after the COVID pandemic, or around the pandemic, there were lockdowns, and then beside of the lockdowns and productivity, which saw a sharp decline, or production saw a sharp decline, you saw supply chain issues occurring, so on and so forth, and that was countered, or not really countered, but central banks around the globe reacted in a very dovish way. So they increased their QE programs, like the Fed or like the ECB, for example. And then you have the combination. Simply speaking, you have lots of supply chain issues in this case, or less supply or less products, and you have lots of money chasing these products, which means inflation will pick up. So this is a natural result out of the policy we've seen as a reaction to the COVID pandemic and everything after that. So there was a pickup, an acceleration with the invasion of the Ukraine by Russia. And so now these supply chain issues, or respectively supply issues, especially in terms of commodities, especially fuel, gasoline, and so on and so forth, results in further higher inflation expectations picking up. And thus you now expect the Fed, or respectively central banks in general, but we would talk about the Fed, to cut their money supply significantly, respectively make money more expensive. Yields are a simple way to have an idea on how much your money is worth. In fact, it's the price tag you put on money. In fact, when we talk about yields, it's the price tag you put on money. And now the thing is that we have seen a tremendous rise higher in equity. So let's just have a look here. Daily chart. So we will probably go here. That was the reaction to COVID, and then we saw this explosion on the upside. So central bank, in this case the Fed, doubled their balance sheet. We saw a sharp rise, and now since the beginning of the year, now inflation picked up, and there is now this restrictive monetary policy approach from the Fed. So we see prices dropping as a result out of this. But then, as you can see here in this area, that was around June, and also in July. If we zoom a little into the chart, in this case in the NASDAQ, you can see here, that was there, July, yeah, here, this area. You saw that the market started to bottom out. Why did it bottom out? Well, the acceleration in inflation on the upside, especially here, the sharp drop that was in June when some inflation data back then was released. This pickup, market participants started to expect now to see the Fed to reach a peak in terms of their rate hikes and the rate hike cycle they started. And this is usually something what explains then why the market reacts in a different way than you would usually expect. So it anticipates what the Fed will do. It anticipated a more restrictive approach already when we saw this sharp decline, which accelerated again in June here, once we peaked out here on the downside. And then once the market saw another pickup in inflation on the upside, the market already started to anticipate that the Fed will cut back their hawkish stance and start rather sooner or later to cut rates again. And this is exactly where we saw this sharp rise higher here. So that was a very, very interesting move on the upside. And we peaked then in mid of August, saw a sharper drop, which accelerated again with the wording which was used from Jay Powell in Jackson Hole at the end of August. And then into the Fed decision, we then saw the NASDAQ picking up again here on the upside, pushing higher. And that's certainly something which is of interest. By the way, and let me just have a look here. Okay, one second. I just have to adopt a little. I will talk about this in a few seconds, why I do this now, what I do. So now the interesting thing about this move higher was that the market already anticipated, obviously it does, anticipated a lower than expected inflation print here, probably one below 8%. And we didn't get this to see. We can see it here. So we came in at 8.3%, still below 8.5, but not as low as the market expected inflation to come in. And so that was, in fact, the main trigger, and what I was referring at the beginning when I talked about this here with Theo several minutes ago, that now with the inflation, we have a clear idea that we probably have not yet peaked on the upside. Probably we'll see a further pickup. The main reason why we saw probably this decline was because there was a sharper drop in commodity prices, whatever the reason was. And now the question arose, well, what will the Fed do as a result? And this is now where we come to today's presentation. Market participants before this inflation event saw something like a 50% chance that the Fed will probably hike rates by 50 basis points. It was a 50-50, like 50 basis points or 75 basis points. You can see that the current target, this is what you can see here, is 225 to 250. And now you can see that what we expect with 80% probability here, this is this column on the left, is 300 to 325, which equals a rate hike of 75%, which means nothing more than now we have a 100% that market participants expect the Fed to hike rates by 75 basis points, and was completely priced out this, let's call it a dovish stance, to expect 50 basis points. Interesting enough, you can see here that we now have a 20% chance among market participants here, according to the Fed Watch tool, which you can find with the link I just posted in the chat box, and which is directly connected to the CME, so the Chicago Mercantile Exchange, and where you get this data, or you will probably wonder, where do we get the data from? You extract the information, especially from yield contracts, for example, from T-note futures, and what market participants see there in terms of yield. And then you build a model here and saying, okay, this is according to the prices we see in the futures market, this is what market participants expect the Fed to do at the next meeting. And this is where we get the data from. So that being said, we now have a 100% chance of 75 basis points, because 80% see 75, the other 20% see 100, which already includes 175 basis points. So it's 100%, and there's no market participants anymore who expect the Fed to hike less than that. So 75 basis points next week is a done deal among market participants, and it's not something special or something. Now you might probably still wonder, okay, if you remember right, and if you followed the action here already before the inflation numbers came out, it wasn't really 50%. In fact, 1 month ago, it was probably 50%. But shortly before inflation data came out, you saw that market participants were already expecting this column here of 75 basis point was already at around 80%. So the other 10, 15, 20% we now put in on top of that isn't justifying such a sharp drop in equities. It's just not justifying it. It's too much. It's mostly priced in. You probably see a sharper drop, or a short drop, let's put it that way, and probably see the market dropping a little. But you can justify, in this case, a sellout, which was something like 700 points or so. Yeah, around 700 points, or more than 5%. It's just too much. You probably see a short pull-in, which is probably then bottoming out something like 12.5, probably 12.4, but it's not justifying now the drop, as you can see it here, below 12,000 points. So why is that? Why is the market reacting that hefty on such a news, which was mostly priced in? And the main reason for that is because market participants now started not to play the Fed next Wednesday anymore, but play the Fed for the next months to come. And this is something what we got to see before this event on Tuesday took place. Markets were pricing in a nearly, what was it? Let me just have a look here. And then we have clear data. You can find this data on Fed Watch tool here. So you can see it here. Okay, this is the link. I opened it already here in the browser. And you see 1 month ago, market participants with 60% probability saw rates to be somewhere between 350 to 400. So that was 1 month ago. You can see it here. That was on the 16th of August. That was shortly before Jackson Hole. And now this probability that the Fed will have a hike or will have a rate level of 350 is at 0%. So market participants not expect the Fed to be at 350 to 375 here anymore, completely priced out, but started to aggressively price in more rate hikes. And more rate hikes means, on the other hand, you take liquidity from the markets away, and thus pushing especially equity prices, who profited especially in the high beta sector, let's call it, and the NASDAQ 100. You saw this push higher, this nearly vertical move post-COVID. It mostly resulted out of the fact that market participants saw no other choice than buying assets or buying stocks which profit enormously from cheap liquidity. This cheap liquidity now gets expensive. So that being said, means, okay, we take away liquidity, and we saw already the market dropping, but it probably didn't drop enough. And this is now what market participants started to play and price in. And now what's getting interesting, you can see that market participants are now here at 425 to 450 in December. That's very important. So you can play around with this. It's not just that it gives you an information on where do we stand at the next rate decision in September, but also here, where do we stand, let's say, in December, so at the end of the year. So now this is very interesting, because you can see 60% of market participants now expect the Fed to hike rates to 425 to 450, 10%, 11% expect the Fed to hike even higher, 450 to 475. So why is this of interest? Well, because after 75 here, 75 now in September, next Wednesday, we see another 75 in November and another 50% in December. So there's one reason to be very skeptical about this, because something I haven't yet prepared, but I will do now. Fed Atlanta is what we will look at here. So first of all, there's the Fed Atlanta GDP tracker. Very interesting, because what they do is they take all the incoming economic data from the Atlanta Fed in this case, and then they project what to expect for a GDP growth to be at the next release. The last two were negative, and they came in, they started something around 2.1% or so. That was around 2 months ago, 1.5 months ago, and now it dropped to 0.5. So we already saw the first and the second quarter an economic contraction. So the US economy is not as strong as politicians want you to believe that, especially in the US. And there's a chance, there's a serious chance that we see another contraction also in the third quarter. So now we find ourselves already in a recession in the US, based on this idea that 2 consecutive quarters of negative GDP growth equal a recession, technically wise. And now just imagine you make liquidity, which you need to somehow stimulate the economy. You take this liquidity away and you force, in fact, the economy in an even deeper recession. So this is the first thing. I don't think that this is realistic. I don't really think that the Fed can do this, especially in the current environment with all the geopolitical tensions we can see around the globe, with right now the tensions forming around also the US and China, again, with sanctions being discussed around the situation in Taiwan and so on and so forth. But this is just a personal take from my end. In addition to that, I mean, or let's put it that way. So that would be my explanation. It's my explanation why I don't think that the Fed can be thus restrictive. Still, the question's still there. Okay, nice, but how can I trade this? What can I do with this now? What if everything is priced in here from the slide before? So why is this then such a highly anticipated event? Why is this so interesting? And this is now where things get really interesting, because next week on Wednesday, we also get economic projections. And these projections also consist of something you can find, and this is something I already prepared. This is the so-called Fed dot plot. Let me just show this here. I opened it already. So this is the economic projections PDF, let's call it. The Fed released let's call it eco projections. They released it at the last meeting in June. And within this, here you can see it held on 14th and 15th of June. This is released once a quarter. And now things are getting interesting because there's lots of technical stuff and so on and so forth, blah, 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 blah. And then here on the 4th page of these 17 pages, you find this technical sheet of paper and look at this and just say, okay, lots of dots, but what does it mean? Well, if you understand what's here, then things start to get really, really interesting because each dot here represents one Fed representative. So in June, 3 months ago, the majority of Fed officials, those who have voting rights within the FOMC, we're seeing at the end of 2022, so you can see it here, 2022, 2023, 2024, and here on the right, you see the rate level they were expecting or they were voting for, they were expecting to see based on the incoming economic data. You could see that the majority of these dots here could be found between 325 to 350. 325 to 350. This is what the Fed dot plot suggested at the June meeting. Since then, lots of data came in and inflation picked up again significantly. Let's come back here to the inflation sheet. So last time we saw the numbers around inflation, which was available, was 8.6%. Then from there, we picked up to 9.1%, and now we dropped. Okay, we dropped to 8.3 again. So inflation came in already below what was seen before the Fed released the last dot plot based on the economic projections and economic outlook these voting members here in the FOMC had around this time. So now the thing is, again, 325, 350 was what the majority expected. Coming back here, one slide before, this is what the market expects. It's not the Fed, but it's what the market expects based on the incoming data. And it sees with the majority of 60% of market participants in December. So this is in December, we have the last meeting in 2022. They see the rate level at 425 to 450. This is 100 basis points higher than what the Fed expected at the last June meeting, which is only 3 months ago. So you can see it here. This is where the Fed watch tool stands right now, 4 to 450. So depending a little on where you draw the line, it's for 2022. And you see what needs to happen based on what the market expects to these dots. They have to move significantly on the upside. And so now we come to a simple question you have to answer for yourself. So to interpret this news event, it's not about what rates or which rate hike do you expect or whatever, but it's all coming back to, do you think it is realistic that the dots will move that aggressively on the upside given the current economic environment? If the answer to this is yes, then you have to draw conclusions for your trades, for the markets you plan to trade. Or you answer, first of all, the question, which markets do I think will be affected the most by this rate decision if they move dots that way? And again, what if this is not realistic? If you come to the conclusion saying, well, I don't see this, I don't see the dots moving that way, I probably see they probably hike their expectations or expectations rise a little in terms of where we stand in December. But I probably see the dots, most of the dots somewhere here in this range, 375 to 400, which is still below what the market expects and what price was priced in and resulted in this sharp drop on the downside. Okay, so the main driver was that the market participants sold shares off or sold gold off or bought aggressively US dollar back based on the assumption that the Fed has to hike more aggressively into the yearly close based on the incoming inflation data. So, and this is now what we will use as an information for our trade hypothesis, or respectively for the potential scenarios. I have two tables I prepared here for the Fed, and I named them dovish scenario, neutral scenario, and hawkish scenario. In this case now, we're only talking about the dovish scenario. So the dovish scenario, it surprises a little because you can see here the Fed hikes 75 basis points. Again, this is a done deal. So this is no new information we can draw out of this. We already know this beforehand. But what's important is the rhetoric from Jay Powell, the Fed chairman, at the news or respectively the press conference, respectively, especially what the Fed dot plot suggests. If there's no change, which is very unlikely, or you probably see it moving higher by 50 basis points, which means then we are coming in at somewhere to let's go back here, which means that we are then moving, let's say, to 375 to 400, which is here, this area where the majority can be found of the voting members. But again, this is something which was not, or which was overrun last Tuesday. So market participants really ignored this possibility. And now what we priced in needs to be priced out again. So which means if we drop sharply, let's say in the NASDAQ, well, then obviously we need to run back higher because we're pricing this out. And that was the main driver for the bearishness. I say the likelihood for such a scenario is not that unlikely. I think it's 50%. It's a coin flip, but I think that this is something we should really think about. It's a serious chance that we get to see something like that. And personally, I think the most attractive asset in this environment would be the NASDAQ 100. I'd like to trade. And you can see here, if we get to see such a scenario, it will be an ultra bullish scenario, which means we should make back all losses from Tuesday, probably even recapture 13,000. How come that I draw such a picture? Let's have a look here at the NQ100. Where do we have it? Oh, it's already there. Yeah. So you can see here. So this is where we started. This violet, the purple line, you can see it here. This is where the inflation candle, let's call it the inflation candle, where it started. And you can see here that we sharply dropped that yesterday. That was something which surprised me, to be honest, because I didn't really see the market dropping here, the September lows now before the Fed, given that this is a serious chance to happen. And in addition to that, not just that this is a serious chance to happen, but also today we have a so-called quad witching. So options expire. And in such an environment, I have to be honest, I don't really expect that much volatility, especially if we've seen so much volatility coming into the quad witching. Sometimes it happens, yes, but given what we saw already at the end of August here, that was kind of surprising, let's say. And we dropped this level. So there was a sharp decline, and I think the market is too restrictive. I just don't see such a scenario here being justified or respectively seeing the market being that much under pressure and considering chances of a retest here of the July lows, respectively to the yearly lows, to be realistic. So this is my personal bias. And now, if the Fed comes more dovish than expected from market participants, driven by what happened over the last 2 to 3 days, I see really a sharp rise higher in this scenario. This is the overlook, or respectively the big picture. So certainly now you need to find out how to trade this then on the lower time frames. Let's just see. So how the price action develops over the last or in the next 3 days. Probably we are about to see further losses now into the weekly close. That was something I just had to change here in the back end in regards to my stop. I'm right now, for example, short the DAX, expecting it to drop 12,700 because the overall picture really looks very, very weak. And if we flush below 12,700, I could really imagine this to be a very bearish weekly close. And this means also that in this context, then certainly the NASDAQ will push lower even further and probably flush below 11,400 in this environment. But again, so the overall outlook I have in such a scenario is that the NASDAQ has a serious chance to push back towards and probably even above the inflation highs, let's call them inflation number highs, and then breaking back above 13,000 points on the upside. So this is the scenario for the Nasdaq. Now let's have a look at gold. We've seen gold breaking below its yearly lows, 1,680. I traded it from the short side. In fact, the break lower yesterday. I considered this to be a high probability trade. In fact, a break below that level, given that these were the 2021 lows, but also the 2022 lows. We see yields rising. We know that gold in such an environment usually underperforms. We see gold underperforming already. This is not just due to the yield development, but also in addition to the US dollar, which is very, very strong. And usually you have a negative correlation between these two. So that being said, you currently see gold being under serious pressure. And right now we hold below 1,680. But as you can see it here, if we get to see such a scenario where we hike 75 basis points, but the dot plot is not as hawkish as the market expects it, then it's probably a fake out, even though I don't want to be long then, but I want to be long once we make it back above 1,750, given the recent weakness we've seen in gold. So in this context, let's have a look here at gold. So there's the break lower. It's a significant low, so or a break lower. You can see it here. So it's not said that we're or it's probably we are not yet done on the downside, but once we get a complete shift, or the main driver for the recent bearishness on the downside, which also can be found in the inflation data, you can see it here. So that was yesterday, but the attack on the downside, so this is gold on a 50-minute chart, was already we prepared for this, let's put it that way, with the inflation data. And then we saw a clear, it wasn't that the inflation data itself created the break lower, but we saw some, let's say, solid selling, or that wasn't like a flush out scenario. It was like a controlled selling, which we saw. We stabilized around the lows that day, then we sold off yesterday again, we drifted into the lows, and then finally broke now on the downside yesterday. But still we hold solidly for the significance of this level. That's noteworthy, let's put it that way. And again, with such a scenario, it's not unrealistic that we push back above the breakout region around 1,680, probably make it back above the levels from before US inflation data, which was around here, 1,730. But still, to get to see such a scenario, we need to wait a little, because the more we push now away from the breakout region and don't make it back, or we don't get to see any kind of, let's say, stabilization before the Fed, the more unlikely it becomes that there will be a pushback towards 1,730. And thus, that being said, already delivers the answer if I'm not that bullish, or why I'm not that bullish for gold right now, even if the Fed comes out very, very dovish with such a dot plot as we made it the topic. So dollar JPY is also a very interesting currency pair. You probably wonder, I prefer, that's why we will look into dollar JPY, not EURUSD. I prefer dollar JPY because of its positive correlation to 10-year US yields. I haven't prepared this, but let me just show you. Let me just show you a chart, which is from my first book. It's a German book, so it doesn't really make sense. I'm here for you to give you now a link. It's called Forex Trading, and then yeah, just look at Amazon Forex Trading if you're interested in this. It's a German book again. But this is a chart that was already released in 2014, so nearly 10 years ago. And this chart, you can already see it here. It's German, but just to get an idea, in gray, you see dollar JPY, and in orange, you see the yield of 10-year US Treasury notes. And you see that they are positively correlated to each other, which means if we now saw a spike higher due to the expectation among market participants here that the Fed will go super hawkish into the yearly close and yields spiked, but then you don't see the Fed confirming this speculation, you expect yields to come down again. If they come down, well, what you expect is the gray line to follow the orange line. If yields go lower, then dollar JPY should go lower. That's the idea behind this. In addition to the fact that technical wise, you can already see it here. dollar JPY. We are very extended on the upside again, and we again accelerated here given the recent developments in yields. And so the thing is now, I expect a pull-in to occur, which will bring us at least back down to 140, probably even below that level. Probably we retest this trend line here on the upside. But all in all, this is definitely something you should keep an eye on too, because FX could see some serious elevated volatility, given its positive correlation here to yields in this case. So dollar JPY potentially seeing a pull in, even though be aware that the JPY is very weak in the current environment. You can see it here, by the way. So there's a high yields correlation, positive yield correlation. You can see it. We started at around 142 and we topped out around half an hour later, 250 pips higher. That's a massive move in such a highly liquid and deep market as the FX market is, especially dollar JPY, the second most liquid currency pair, most actively traded currency pair as the EURUSD. So seeing such a move higher here shows already how much potential for elevated volatility can be expected if the Fed pushes yields significantly lower by offering such a dovish dot plot, given what market is expecting. So these are the three scenarios for the Nasdaq, gold, and dollar JPY, and how to get there, given the recent data we saw around inflation. There's certainly a second scenario you need to make a topic. It's not sad that this plays out, even though I think it's a high likelihood that it plays out that way. You can see it here. I have already only 40%. So there's a last thing where I say, well, what if the Fed really hikes or raises its dot plot to the level the market is expecting right now? I was surprised once this year already with such a stance, even though the reaction in equities was very bullish. That was in March. Probably review this again. Probably we find ourselves in a win-win now for equities, not right now, and we shouldn't consider long engagements in the current environment, at least not given the current environment or current situation price action wise, but we probably in a win-win situation post the Fed on Wednesday, so in the second half of next week and into the quarterly close. But still, the neutral scenario is the 75 basis points as a given. And then we see that the Fed dot plot moves only 75% instead of the 100%. And that means nothing more than, let's go back here, that if we price out these two columns here to this level, 400, 425, that's also something which is likely to result in a bullish reaction in the Nasdaq in this case, even though I'm not really seeing it making back the losses completely, but probably only some of the losses from Tuesday. Probably first target can be found in the Nasdaq then around 12,300. Let me just go here to the Nasdaq. So 12,300 is a level. Let me just see if I can, probably going lower a little. So this is 12,000, probably making back 12,000 and then pushing back above this consolidation high. I'm sorry, from Wednesday. Probably then we saw a spike back above that level. Probably at least part of this inflation sell-off, the part of the second half of the trading day. That's probably something to keep an eye on, and then probably something we could see here in this context. Gold also bullish, but then depending a little on what we get to see right now, but we need to recapture 1,680 first. It's the first step for longer term engagements in gold. I really don't see long positions right now below 1,750. But we need to see if we make it back above 1,680. It's a likelihood, which is certainly, it's possible that we get to see this, but even though we didn't need to be patient and see whether we can make it back above 1,700. And the only scenario, in fact, where I think the neutral scenario and the dovish scenario will play out in a very similar fashion is in dollar JPY. So in both cases, in both cases, I could imagine a retest of 140, given this very, very extended mode here on the upside. Where do you have it again? Dollar JPY. There we go. So given this very extended mode here, and you can now play around a little. So probably you remember some webinars we did earlier here within this Trading Spotlight webinar series, very extended, slightly higher highs. We are not confirming these highs anymore with the RSI. That's something which already showing some of the bullish momentum we've seen in dollar JPY is probably diminishing. Short term, we are very extended, probably a push lower, especially if we break below the lows from before the inflation data was released. That's around 141.50. Probably that's good for at least a short-term scalp. Then on the downside, that's probably something to keep an eye on here, and where I could imagine 140 also in the dovish, but also in the neutral scenario to play out. And in fact, that's it. So I hope I gave some insights, not just into how to interpret this data set, given the most recent data, but also how to draw conclusions out of what to expect for the market. I highly recommend re-watching this video. If you watch the recording now, then probably re-watch it. If you have questions, please feel free to ask them below. It's a very, sometimes it's a very pathologically wise topic, let's say, and you really, it's sometimes getting a little complicated, but it can make things lots easier once you are, and put this in quotation marks, under fire. Once the news is released, I really expect the Fed next week to be highly volatile, a very volatile event itself. And then if you're not prepared, if you don't know what to look for and why the market is reacting the way it does, or you have really no clue of what's right now happening, then it will be very difficult to find an edge in this environment, and then formulate a trade hypothesis. So do this beforehand, understand why the dot plot is of importance, and based on that, which markets could be of interest, and then take it from there. Formulate scenarios, a table, and use this then to trade based on your personal assumption. Probably you come to a how can I say, a complete different idea. Please share this. So if you say, Jens, you're a nice guy, but I don't share your point of view, please share this. Because to me as a trader, it's very important to use the input and let's say a view which is completely countering my view. It's very important because this helps me to reformulate, to review my hypothesis. Probably it helps me to formulate a setup which is instead of NQ100 bullish, it's a short one, and it's the trade of the year or something like that. So that's one of the reasons why I really enjoy discussing the markets also with you. So use the chance below the video, share your views, and that's it from my end. Again, by the way, very important. First of all, these are the contact details for Admirals. Theo already shared everything. Very important. So we made several potential trading setups a topic here. These are not advices, or this is not something you should take as an advice, a trading advice or investment advice. So it's just an idea, purely educational content which was provided here. Please, this is the risk disclaimer. Read it carefully. Understand that every trade, based on the ideas I formulated here, you take it on your own responsibility. It's you taking the risk. But the good thing about this is, if it works out, then you can keep all the profits too. So that's it from my end. So all the best. I wish you a nice weekend. And talk to you next week again. I really look forward to it. And bye-bye.